Good morning, everyone, and welcome. It's great to have so many dialing into today's session, a stock pickers market, quality and value still on offer. I'm Jason Guthrie, Head of Wholesale at Natixis, and today I'm joined by some of IML's small and mid-cap team there in Sydney. Welcome, Marc and Lucas. It's great to see you both this morning.
Hi, Jason. Hi, everyone. Hello, everyone.
Now, Marc is co-portfolio manager on the Future Leaders Fund at IML, as well as being co-PM on the Private Portfolio Fund and Absolute Return strategy run by the firm. Lucas is also a PM and an analyst in the team there, mostly focused on the Smaller Companies Fund, and has worked closely with Marc and lead PM Simon Conn for many years in the small and mid caps. So today, look, Marc and Lucas are going to discuss some of the key drivers behind the market, what company management teams have been telling them over recent times, and some of the main investment themes flowing through their portfolios. They're also going to spend a bit of time on valuations and yields and some of the M&A activity happening in the portfolio, finishing maybe with some highlights on some of the key companies where they have particularly strong conviction in the portfolios today. Now, before I do dive into the session, I just wanted to quickly touch on and recognise the team having been nominated recently for with Lonsec Money Management Fund Manager of the Year Awards as a finalist. This is off the back of another recent nomination with Morningstar. So it's really great recognition for the team there. Good luck to the team. I know the guys work very hard to deliver, solid, impressive returns, but more importantly, consistent outcomes for our clients. If you'd like to hear more after this session, please do tune into our new podcast. It's called Navigating the Noise. You can access via our website and some of the major platforms like Amazon, Apple, and Spotify podcasts. The quarterly updates are there, which is quite handy. And the latest episode is actually with one of the analysts at IML, Bruce Du. It's a really interesting chat. It's short and sharp, covering IML Stock of the Month, ResMed. So I encourage you to listen into that. We will take some questions at the end. Thanks to those that have submitted some questions already. Feel free to add more through the application over the next 15 or 20 minutes. And that's really it from me, guys. Please enjoy the session. And I might hand over to Marc and Lucas in Sydney to get going and talk through this exciting part of the market. Thank you.
Thanks, Jason. Thanks, everyone, again for joining us. We're actually very excited to share our ideas and views on the market with you. So Lucas and I are clearly working on the smaller mid caps. I thought we'd just start with a brief introduction in terms of how we're seeing the market and how we're seeing things. And I think it's fair to say, markets and volatility have certainly been running hand in hand of late. That's a bit of an odd comment, you might argue, given markets are sort of approaching all-time highs in many ways. But it has been volatile, and the data is quite mixed. And clearly, inflation is top of mind for everybody still, and what we're seeing is inflation does remain sticky. So that's always looming in the background, and the debate and the arguments really around where inflation is going and what central banks and the Federal Reserve doing in response to that. But certainly domestically, it's all about a very mixed outlook. A number of updates we've seen recently, particularly from the consumer retail side of the market, has been quite soft. So while there are mixed tailwinds out there in terms of the economy, I think it's fair to say that consumers generally are seeing things a little bit tougher given the cost of living. But this webinar and this presentation is all about what we think is an ideal stock picking market for stock pickers such as ourselves. And the opportunities we're seeing out there are actually quite exciting. So despite the fact the market's had a reasonable run, you could argue valuations in some parts of the market are elevated. We are still seeing plenty of what we think are great opportunities, focused on valuations, focused on income, focused on the yields that some of these small and mid-cap names can generate for us as shareholders. And one of the key points we want to leave with you is discipline remains key. So it is about stock picking. It is a mixed environment. It is increasingly about picking the right sorts of stocks given that mixed background, but remaining disciplined, focusing on valuation, focusing on cash flow, focusing on what matters, not just chasing things, but actually looking at companies and understanding what you own, I think is all important. So they're the main points we want to leave with you today. And it's quite interesting. We've had quite a few updates, haven't we, Lucas, just recently from a number of companies in our portfolios and companies that we're looking at on an ongoing basis, just to get a feel for what's happening. And I think this slide can look a little bit complicated, but I think the main takeaway from this slide in particular is the fact that from a discretionary point of view, the consumer is still doing quite tough. So we had a very good update, for example, from GD Holdings, which is one of the key holdings in our small and mid cap portfolios, and they operate in the auto aftermarket. So wear and tear auto parts, four-wheel drive accessories, and so forth. Now that stock's been quite weak of late because the market was really focused on the health of the consumer, and there was a real concern that company would have a downgrade. But what we saw with their trading update provided just the other day was that their wear and tear auto business is actually performing quite well. It's hanging in there. So where the consumer needs to spend money, they're still spending money, and that's really a function of the fact that people have jobs. You know, governments are spending in the economy, so there's still a few tailwinds coming through the economy from that point of view. But where consumers have a choice where to spend their money, so on that discretionary part of the market, they're certainly starting to pull back, and we saw that last week with a number of updates from the likes of Baby Bunting, JB Hi-Fi, Super Retail, all being generally on the softer side of expectations. In terms of company health, what we're seeing is that balance sheets and cash flows actually still remain pretty decent. So it's not all doom and gloom out there. Company balance sheets generally are relatively healthy. They are generating cash. Inventory management's been stronger. Working capital seems to be under control, and there is that population coming into the country. So there are some genuine tailwinds there as well. So again, as we say, a mixed bag. Some pros, some cons, but again, a stock picker's market.
Yeah, I completely agree with that, Mark, and I think it is worth pointing out that definitely the consumer's feeling the pinch a little bit. We can see that in what companies are telling us. We can see it in the credit card data coming out of the banks. But the broader economy is still reasonably healthy. Australia's terms of trade are at record highs. You know, we've all seen the budget surpluses that the government's delivered in spite of themselves over the last couple of years. There are large pockets of the economy that are still doing very well. But as you say, overall, you'd almost characterise it as mixed. There's a lot of things moving in different directions. And so as a result, when we look at our portfolio, and very much as you say, Mark, a stock picker's market, there are still some themes that we come back to. And really what we're looking for are companies that can kind of grow absent the economic cycle. And you can see some themes up on the screen there of stocks that fall into those buckets. So, you know, you look at the utility-like companies. These are companies that grow earnings really absent any impact of the economic cycle. Companies are adding value through acquisition. Mark's going to talk about Sigma Healthcare and their big acquisition of Chemist Warehouse later in this presentation. The likes of Ridley and SG Fleet that have created a lot of shareholder value through acquisitions. And then areas like defence and healthcare that we really like in terms of long-term structural beneficiaries in healthcare with the ageing population, increasing government spending, and certainly in defence. You know, it's a lot of unpleasantness in the world today, but really what we are now seeing is countries all around the world are rearming, and we're seeing more and more government spending going into defence, and that's been a real tailwind for Austal and also for electro-optic systems within our portfolio. And, you know, while we remain very cautious on taking on domestic cyclical exposure, so, you know, you mentioned the discretionary retailers, Mark, we don't really own any in our portfolio.
No, that's true.
Where we have been willing to actually take a bit more of a cyclical bet is around the energy transition. Based on our view that, you know, while commodity prices certainly are heavily cyclical, we do think that there are long-term tailwinds behind commodities like copper. I mean, basically the world is going to need more commodities, not less, and those commodities are going to be harder to get out of the ground in the future than they have been in the past. And that's why we really like the idea of investing in the picks and shovels. So the likes of ALS, geochemistry testing being the biggest part of their business, Index, a mining services technology provider, a real global leader in Australian small caps. The backwards looking drilling updates haven't been so strong, but you look forward with copper prices where they are, we feel really excited about the future. And then Cooper Energy, I think we've all seen that the government's had a bit of an about face on the need for gas and future gas flows into the domestic economy. Cooper, one of the largest providers of gas to the East Coast into the Victorian market. It's a position that we really like. It's had a good run this year, but we think there's still more to come.
Yeah, and I think it's fair to say, Lucas, when we talk about the IML approach to investing, we look for companies with recurring earnings, sustainable competitive advantages, good management teams, earnings that are recurring and sustainable across the cycle. And a lot of the names on that slide certainly fit those characteristics, don't they?
I think that's absolutely right, Mark. Further to what Mark was talking about earlier as well, in that, yes, the market as a whole has had a pretty good run. So we don't think you're necessarily the best thing that you want to do investing forward is just to go long beta US tech, and that's how you make your money, because the surest way to destroy capital is to overpay for something that has perceived safety. But as you can see from that chart, small industrials really have lagged the market in a major way over the last 3 years, despite the recent rally. And so I think it's no surprise that we are still finding really good value on offer in some high quality companies.
That's right, and it's not only valuation opportunities, but also sector opportunities. And if we go back to that previous slide, you can see that just diversity of sector exposure and economic exposure that you get, which you don't really get in the large cap. So we can play different parts of the economy. We can really work our way through what's on offer and find the best available and quality opportunities.
I think that's a great point, Mark. And I'd even highlight healthcare there as an area that's been, IDX and ACL have both been sold off over the last year or two on kind of labour cost issues, maybe some impact on volumes from lower GP attendances. But it hasn't changed the future outlook for the business. So we don't think it fundamentally changes the value of these companies. But the market is very fixated on short-term results these days, and that really creates opportunities for long-term investors such as ourselves.
That's right, that's correct. So I think the key point to take away from those last couple of slides, ladies and gentlemen, is just that, yes, the market's had a bit of a run. We are seeing some, I guess, areas of froth in the market, but there's still plenty of opportunity in that small and mid-cap space. And this slide here, this table really just highlights to you some of the key holdings in our portfolios and really the valuations and yields that are on offer. Look at some of those PEs, the likes of GUD's had a bit of a bounce after its trading update on Investor Day yesterday, but still only 11 to 12 times. The likes of SG Fleet, which is a market leader in fleet management and one of the market leaders in novated leasing nationally, only on 11 times. And those dividend yields, well in excess of 4, 5, 6%, often fully franked. So these are the opportunities that we're finding. So despite some of the parts of the market being elevated, as we say, there are still plenty of opportunities to find what we think are good quality companies. If we focus on income, we focus on the fundamentals, focus on discipline, we can find these opportunities, and that's what we're doing, which is why we're excited to be talking to you today and why we're excited about the outlook for the portfolios going forward. And the last point we make to you before we get onto stocks is just often stocks will remain at good value or attractive value on the market for a long period of time. They'll be ignored by big parts of the market because they're not in favour. They're not
an index.
They're not the flavour of the month. They're out of the index. But often what we find, and we've certainly seen that in our portfolios over the last 6 to 7 months, is where the market won't realise the value on offer, somebody else will, whether that's a corporate buyer, private equity, some sort of other corporate buyer. We often see these stocks leave the market through M&A, and that's what we've seen. Our most recent example, Lucas, there is Quantum Intellectual Property. That's currently underbid at basically twice what it was trading this time last year. So some significant opportunities there as well to realise value for unit holders, which has been great. Now we want to move to stocks. This is really the exciting part of the presentation, certainly from our point of view, and I'm sure from yours. But the first stock we want to talk about is Sigma Healthcare. Now, this is a stock that's been very topical of late, given its proposed tie-up with Chemist Warehouse. Everybody knows Chemist Warehouse. A lot of people probably didn't know who Sigma Healthcare was. And I think from our point of view, this is certainly a very good example of a stock pick in our portfolios, which has come good, which is why we're talking about it. But really, the key point I want to leave with you here is that when we're out there looking for opportunities, often unloved, often underdiscovered, often out of the index, now, these are the sorts of opportunities that can come up and really deliver for you over a period of time. So for those people not familiar with Sigma Healthcare, it is one of the 3 national players in the pharmaceutical wholesale space. So when you think about the PBS, ethical drugs delivered to the back of store of your community pharmacy, it's a like of Sigma, it's a like of Australian Pharmaceutical Industries, it's a like of EBOS that deliver these drugs to your local community pharmacy. And so Sigma is one of the 3 largest players in that space. We've always liked pharmaceutical wholesaling because it's a low growth business. It's typically generated very good cash. The earnings are very predictable. It's very hard to get entry into that industry. So once you're in there, the barriers to entry are actually quite high. And so it's ticked a lot of those boxes that we like from those sustainable competitive advantage points of view. And Sigma came on our radar screen probably 2 years ago for a number of reasons. Firstly, valuation. It looked very cheap at the time. A new CEO came in called Vikeshwar Masunda. He came from Clicks out of South Africa, which was a pharmacy retailing business over in South Africa. So he had a very good background, not just in wholesale, but also in retail. And so he was bringing that experience to the Sigma experience. And also Sigma had been through what was a very deep CapEx bubble for a number of years. And the company had just started to put that CapEx spend behind it and start to reap the benefits of its investment back into its distribution centres, into its logistics infrastructure and so forth. And so we thought it was an ideal time to look at this particular company. At the same time, they had the front of store wholesale contract for Chemist Warehouse. So when you thought about the pharmacy industry and pharmacy retailing, Chemist Warehouse presents as probably the best-in-class retailer in the country, not just in pharmacy retailing, but in retailing in general. It's certainly a category killer, a market leader. Over 600 stores nationally branded Chemist Warehouse, and over 50% share in pharmacy spend, despite being only 10 to 15% of total pharmacies nationally. So it's certainly a category killer, and we're getting, I guess, a second-order exposure to Chemist Warehouse by Sigma with that front of shop exposure there. Subsequently, they won the back of store contract with Chemist Warehouse, so they had the total wholesale business for Chemist Warehouse, delivering the front of store FMCG type products, and also the back of store products, those ethical PBS drugs, which people buy from their pharmacies. Lo and behold, subsequent to that, we've had that proposed merger with Chemist Warehouse, where not only do you have the exposure to Sigma, which we think is a great business in its own right, but you also get that first order exposure to this wonderful retailing opportunity that is Chemist Warehouse, the number one retailer in the country. As I say, a tie between the two gives you over 1,000 retail shops, Chemist Warehouse, Amcal, My Chemist Discount Drugstore, and also a wider wholesale buying group of about 2,000 pharmacies in total. So that's a wonderful opportunity. You can look at those charts there on the slide. It really shows you the growth of the Chemist Warehouse group over the last basically 20 years or so, and that's a compound growth of over 10% per annum over that period of time. Really is quite impressive, and so that's really what you're getting currently if the proposed merger goes through. And not only that, you get a wonderful growth exposure going forward with, again, further additional rollout of Chemist Warehouse stores across the country. For example, New South Wales is only half as penetrated as Victoria when it comes to the Chemist Warehouse footprint. So again, a lot of run room for them to continue to grow that footprint, and also offshore as well, the likes of New Zealand, where they've done really well, and also the prospects of moving into Europe. They're currently in Ireland, but Ireland really being a stepping stone into the UK, and so on. So for us, it's a wonderful opportunity. It was a very significant weight in the funds at over 4% at one point. And the fact that we were close to the company meant that we got to participate in the capital raise that they conducted back in December, which really gave us a greater weight in the stock and has really performed well for us. We've been reducing it a little bit just on the strength of the share price, but again, it still represents what we think is a very good opportunity for the funds going forward. Now, I'll pass on to you, Lucas, so you can talk us through one of your stocks.
Yeah, thanks, Mark. So, look, I don't think anyone on the call needs to be told what a juggernaut Chemist Warehouse is. One of probably the highest quality retailer in the country, as you saw from those charts. A company that's maybe a bit less of a household name because it's not consumer facing is Kelsian. Although if you've ever been to Kangaroo Island, you might have seen the old logo when it was called Sea-Link. But Kelsian again fits in that bucket we spoke of earlier of utility-like businesses. So the marine and bus operator Kelsian, you can see the contracted revenue percentage on that bottom right corner. That really, in a single chart, explains why we like the business so much. They get pass-throughs on inflation, they get paid per kilometre, and their government-run bus contracts in Australia. They've got a slightly different model in the US, but again, highly contracted, generally a corporate customer base there. It's actually higher margin, and really does give them these infrastructure-like cash flows. Stock sold off a bit at the first half result based on what we view as backward-looking issues regarding driver availability. But the long term, you could just see that EBITDA growth that they've delivered in recent years in that chart in the top right. We think the stock's very reasonably priced on less than 14 times PE. Given the yield and growth on offer, we think the acquisition of All Aboard America in the US has been a home run. And we also know that this is a business that has shown a strong ability to grow organically via tender success. Interestingly enough, their closest competitor, Kinetic, is currently up for sale at a much higher valuation that they're asking for than where Kelsian trades. And yet their book has largely not ever been tendered before, which implies a big margin step down in the future. Whereas Kelsian, lots of tender success, recently won a bunch of new regions in Western Sydney. There's a whole lot of tenders coming up in the next year or two. We think they're coming into a really good couple of years, and it's a company that we remain really excited about.
Yeah, thanks, Lucas. And I think you'll find the similarities between a holding like Sigma Healthcare and a holding like Kelsian is the fact that the revenues are very resilient, aren't they? So, pharmacy, very resilient, public transport, inflation protected contracts.
Yeah, I think that's
the box risk.
That's the key point, Mark, is that even the fare box, as you say, is just pass through. So during COVID, they actually still received all their contracts revenue, even though no one was on the bus.
That's right. So again, that recurring revenue, that we really like that about the stocks that we look to own, and these are two very good examples. Another example we can take you through quickly is Australian Clinical Labs, which has been a little bit I guess, underwhelming in recent times in terms of its share price performance. And really that's on the back of the, I guess, the continual disruption coming out of COVID. So clinical ACL is the third largest pathology provider in the country. There's a number of reasons why we really like this stock. I mean, first and foremost, it's trading on a P of less than 12 times and a dividend yield of over 6.5%. So every day of the week, that gets me interested. But again, it's not just about the purely the valuation, it's what the company offers in terms of its ability to grow its national footprint over time. It's in healthcare, it's in pathology, an industry that grows at over 4 to 6% per annum on a consistent basis. Yes, there's a little bit of indigestion coming out of COVID, as we say, but again, population tailwinds, aging demographic, the fact that pathology and diagnostic imaging as well are becoming more a part of healthcare prevention as much as a healthcare diagnosis going forward is key to us. And what we really like about Australian Clinical Clubs in particular is that they've actually invested in their laboratory networks, laboratory systems over the years, so that they can scale up and down when it comes to workflow. And if you're a pathology company, it's all about utilization, getting as much volume through your laboratories as you can. And when you've got the systems in place to manage that workflow, you can optimize your utilization of your labs. That's something that some of the more higher profile listed peers haven't done over time, and they've got issues around that as a result. Whereas ACL's being able to manage their workflows, manage their costs, manage the utilization of laboratories as a consequence. And that's what I really like about this story. Management is very good. They've got the ability to grow nationally. They've got a couple of bolt-on acquisitions in front of them potentially, which will continue to grow their footprint. And as they do that, they'll just increase the volumes that they can put through their labs, and the efficiencies and scale opportunities on the back of that will continue to grow as well. So very cheap, good quality, fundamentals are very strong. Like this business a lot.
Thanks, Mark. Another one we like that we've actually owned for a long time, but probably not spoken about too much is EQT Holdings, used to be called Equity Trustees. And maybe that's because the business is a little boring. But sometimes boring is beautiful.
Boring is beautiful.
Sometimes boring can be beautiful, and I think EQT is a gorgeous company. So as you can see, it's been around a long time. Trustee service provider, really benefiting from the trend towards outsourcing of trustee services, which is really a function of the increasing complexity, compliance and regulation around financial products. It's a high quality compounder, sticky recurring revenue base, very broad and diverse client base, and made a really good acquisition a couple of years ago with AET, which delivered them scale and also geographic reach into Perth and Adelaide. You might have heard of EQT's main larger competitor, which is Perpetual, and really does highlight the value that's on offer with that proposed transaction on around 14 times EBITDA KKR a bid for Perpetual's corporate trust business. That compares to EQT trading around 10 times EBITDA with faster growth over the past few years. So it's one that's been a good contributor for us. Remain very high conviction.
Yeah, just a great earnings compounder, as you say.
And as you say, Mark, just really comes back to those, the IML mantra, what we look for, a very recurring revenue base, super high quality management.
Yep.
Really ticks a lot of the boxes that we look for.
Yeah, absolutely. And so that really takes us to some of the examples of companies that we currently like a lot in the portfolio, and I guess examples that really highlight the process and the stock picking selection that we undertake when we look to add stocks or new ideas to the portfolio. And I think these are all four very good examples of that. And some of them have short-term headwinds, to be fair, but sometimes you need those warts to create those valuation opportunities. So a company like ACL, as I say, I think is a great business, going through some short-term headwinds, but that's the opportunity. That gives us a chance to pick this stock up at a P less than 12 times and a yield of over 6%. And you've got to be ready to take advantage of those opportunities when they present themselves. And that's why we get excited. So in conclusion, just to wrap it up before we go to some Q&A, as we said at the opening, at the outset, markets are volatile, they'll remain volatile. But in that context of volatility, that's where the stock picking opportunities we feel are really beginning to emerge, and we're really excited to be able to take advantage of those opportunities. We think M&A is ongoing. So we had a slide there which we highlighted to you quickly about the M&A that we've seen in the portfolio. I think that's going to continue. And if the likes of an ACL, for example, stay that cheap for that long, generating the cash that they are, the growth that will come in front of them, then we're going to get more M&A outcomes in the portfolios as well. And we're very focused on income. We want to own stocks that pay us a yield, preferably fully franked. And it's a good discipline for management, generating good cash, paying some of that back to shareholders, reinvesting some of that back into their business. That's the sorts of companies that we want to be owning. So that's pretty much it, Jason, in terms of the presentation. If you wanted to move to Q&A in the last 5 minutes or so.
Fantastic. Thank you, Mark, and thank you, Lucas. I don't think I've ever heard a company be called gorgeous before, so that was interesting. But
I think Lucas was looking in the mirror when he said that, but that's okay.
Some nice ideas coming through at the moment from the team in the portfolios. It's great to see, I guess, despite a strong market, there still seems to be some value on offer and some opportunities for the team in small and mid caps. And I know, Sigma Chemist Warehouse, we touched on that on Tuesday with the large cap team, so that's pretty exciting position for the team.
Well, we were there first, Jace, just so you know.
You were there first, yeah.
We bought it when it was just Sigma. They waited till it was Chemist Warehouse.
Look, we do have some questions that have come through, so we've got 5 or so minutes, so let's get through those. I know you mentioned at the start just around inflation. Obviously, everyone still talks about day-to-day on rates and inflation. It's driving markets. What is the team's view maybe through the rest of 2024 here in Australia on rates and inflation?
Yeah, I mean, I'll take that one. I think it's fair to say, Jason, that we can't see rates coming down anytime soon. I think that inflation is still sticky. Yes, we had a softer print overnight in the US, but I think domestically, what we're seeing from an inflation point of view is that inflation is higher for longer, and as a consequence, rates at best are flat. So I don't think the RBA will put rates up. I know that's a current line of thinking in some parts of the market, but certainly we don't see rates coming up anytime soon. And so in that environment, again, picking stocks that we think can continue to deliver where the consumer is a little bit soft, more conscious of that cost of living, where that revenue and earnings line is more predictable and recurring and resilient and arguably boring. They're the sorts of names that we want to weigh in. And we can marry that up with valuation and opportunity, then they're the sorts of names we want to add to the portfolio.
Okay, great. Maybe looking at a sector or a trend that we haven't touched on. I know you're probably going to love this one, Lucas, given your coverage of technology space. Artificial intelligence, AI, certainly driving markets offshore in a big way. What are the team looking at here in Australia, if anything?
Look, it's pretty hot, but it's obviously a hot topic and a hot sector globally. Not that there really is an AI sector in Australia. I guess what I'd caution investors in doing is just looking at that first order beneficiary and going, well, okay, what do we need for AI? Data centers. Let's buy data centers, because you look at the valuations and we just think they're crazy. I mean, NextDC and Macquarie Telecom, they've gone parabolic, and I can't get anywhere near the current share price on fundamentals. The fact that they're getting AI revenue doesn't mean that you should just buy the stock. But where we try and look is the second order beneficiaries and chatting to companies. Everyone needs strategies around AI, whether it's ReadyTech offering AI co-pilots to their customers in order to generate additional revenue, or it's Integral Diagnostics seeking efficiencies in looking at scans using AI algorithms. So it's not saying that we're blind to, but at the same time, I think our investors know what they get from IML, which is we don't just chase the latest hot trend, and we certainly don't try and climb aboard a bubble.
No, and that's where the sense of discipline comes from, right?
Absolutely.
An idea can be a great idea, but if the fundamentals aren't there and the laxity around discipline and valuation isn't there, that's where you can get.
Yeah, I mean, the reality is, Jace, no one knows who the true winners are going to be of AI, just like no one knew who the true winners were going to be in the internet back in 2000, because it certainly didn't end up being the telcos, and it didn't end up being pets.com either. So, no one's got a crystal ball, so we look for companies that are looking fundamentally cheap right now today. Yeah.
Great, thanks, Lucas. Just maybe turning to a couple of stocks. There's actually a few questions on Southern Cross Media. It's been in the papers lately. Anchorage have pulled out of the bid. So what's the position? Is it still held in the portfolios? I know you've talked about it in the past. How are we looking at that today?
Yeah, thanks for the question, Jace. Obviously has been very topical, as you say, with that bid falling over. Look, it's obviously a disappointment to us. We've been very vocal in being supportive of that transaction and industry consolidation in traditional media more generally, which we still absolutely think needs to happen. I wowould point out we've got larger holdings in ARN than what we do in Southern Cross within the portfolios. So we're still assessing what we do longer term there, as unless there is a third player that comes in to take Anchorage's place in that transaction. What I would point out is that the trading update from Southern Cross yesterday was actually the best one that we've had from them in a while. They've been really proactive on taking cost out under new management. We had a good conversation with the new chairman as well. And we do think things are improving for them. Stock does remain optically very cheap on around 10 times next year's EPS. But as I say, it is disappointing that transaction doesn't look like it's going to eventuate, because we were supportive.
Okay. And maybe last one, there's been a question around, is it Trajan Group? Correct me if I'm wrong, but looks like a pretty interesting business in life sciences. It's quite a small cap stock, I guess. What's the investment thesis being there?
Again, that for me, this is a great example of a stock with a couple of warts or short-term headwinds in front of it, where the market's lost patience, sold the name off, and it's got very cheap. And for us, we bought a big line of it just the other day about 65 cents.
65 cents.
It's quickly from some. Off on a disappointing trading update back to 95, 96 cents. So that was a nice little short-term, I won't say trade because we don't trade this, but again, we're adding to a position of what we thought was a compelling price given the market's been impatient. Trajan, for those who aren't familiar with it, operates in the analytical laboratory space. So they provide high precision instrumentation into laboratories. So I think high precision glass syringes, for example, or slides or chromatography tubes or columns into these laboratories. So whether it's looking at clinical R&D, whether it's pharmaceutical research, whether it's food testing or environmental testing, these are the consumables that go into these laboratories.
It's amazing the level of precision. I mean, you're talking about things that like hollow containers that are measured in the width of microns.
Yeah. So when we say syringes, we're not just talking your run-of-the-mill pickup from the local pharmacy. Yeah. It's very high precision, really high quality glass, very specialized instrumentation. And so these are all consumables that are consumed over a period of time. And that life sciences sector industry, the likes of Agilent, Thermo Fisher, even ALS that we talked about in the food and environmental testing side, that's an industry that grows at probably 6 to 8% a year. So the headwind for Trajan isn't revenue. Revenue is actually doing quite well. It's actually ramping up the operations to match the restocking that's going on in the industry, and that's been a little bit problematic for them at the moment. So there's a bit of cost that's gone in as a result. But we really like that story. Again, it reminds me of Australian Clinical Labs, just a great opportunity in front of it, a couple of short-term headwinds. Valuations become compelling. It's trading on something like 10 times EBITDA next year, which in that life sciences sector where the bigger, obviously larger scale competitors are trading more like 25 times EBITDA. We're not saying Trajan should trade on that, but there's certainly a disconnect in valuation between where it's currently trading and where we think it should be over time.
Fantastic, guys. We might wrap it up. We're a few minutes over. So thank you again, Lucas and Marc. We appreciate it. It's great to see you. And thank you to our clients for attending, of course. We hope you got some value from the session. And if you want to discuss any of the strategies at IML in detail, please reach out to someone on the screen there in our team. Enjoy the rest of your day. Thank you.
Thanks, everyone. Have a good one.